Good afternoon, welcome everybody to today's live event brought to you by Interactive Brokers. I'm thrilled to have on the screen here with me Matt Cashman. Welcome, Matt. How are you?
I'm doing great. Thanks for having me today, Andrew. I'm excited to talk about options yet again.
And you wouldn't know that it's like 10 degrees outside and freezing cold, probably the same way you are in Chicago.
It's warmer today than it was for the last 4 or 5 days. I went for the last 3 days, I think, without leaving my house. It was between negative 15 and 0 degrees, so I stayed inside.
It's not pleasant, but we've got the sun pouring in. Okay. Matt, we're going to be talking about volatility, and you're going to open up the toolbox. Tell us what we're going to learn, please.
Yeah, absolutely. So as many of you know, if you've been on podcasts or webinars with me before, volatility is one of the things that I kind of always build into any kind of discussion about options because it's one of the most important parts about options. Last month, we did something called implementing volatility strategies. And I went through and thought a little bit more critically about it and thought, you know what, like maybe we need to go back to the beginning, especially since it's the beginning of 2024, and talk about some of the most basic volatility strategies, give people a nice broad understanding of how they work conceptually. And then we can work on building through some of the more complicated or more advanced topics as we go. We're going to touch on basically straddles, strangles, and condors today and talk about how they work, why they work the way that they do, and give you a little bit of some real world applications as to how you might think about these on an everyday basis.
Very good. Okay, I put up on the screen while you were talking there the Interactive Brokers disclosures, and I know you've got your own set, but for the benefit of the audience, we'll be talking about risky products. Please take a moment to read the disclosures. And you should have had a chance to catch up with the OCC risk disclosure from the hyperlinks too. So Matt, I am going to make you the presenter, which means you're going to share your screen.
Indeed.
Do that, and there we go, over to you. Folks, it's a live event. Please do put questions into the chat panel, and Matt will take those questions throughout or at the end. I'm also going to make Matt an organizer so that he can see questions coming in. You will receive a link to the recording.
Everyone can see my screen. How's it look, Andrew?
Looking great, Matt. We're seeing a slimmed down version in the camera and the life-size version on the
slimmed down version. Wow. I mean, just so wonderful to hear that, Andrew. Thank you very much. I appreciate those little Easter eggs every once in a while. It's a wonderful way to start a webinar. So, Andrew, I appreciate that. Hello, everyone. My name is Matt Cashman. I am the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. I'm going to give you a little bit of background on myself very quickly. I started trading in 1998, and I've been an options trader ever since. I got my start trading in Chicago on the floor of the CBOE. I traded there for a couple of years and then pretty quickly moved to London and traded derivatives in London on the German bond and index products over there. Eventually, I moved back stateside after about 3 or 4 years, where I started and ran an index options market making operation for the better part of about a decade, again on the floor of the CBOE. Currently, I work at OCC helping individuals and investors to better understand both the risks and the benefits of exchange traded options through efforts like the webinar that you're watching today on IBKR. On a side note, I want to make sure, and I always try to make sure that I mention this, particularly on IBKR when I do these, that it's important to recognize the efforts of the IBKR education team and what they really pour into the actual content that they produce on their site. It is of the highest quality, and I'm not just saying that because I'm involved in it a lot of times. I'm saying that because it actually is of the highest quality stuff that they put out there. It's not something that happens at every brokerage. Make sure that you go over to the IBKR campus website and check out everything that they've put out. Particularly the last podcast that Andrew put out on Tipper X is fantastic. I definitely recommend that you check that one out. It's really great. So a quick thank you to everyone on the IBKR team. They're always putting out really great stuff, and I think it's going to be a great 2024 for all of us going forward. So a little bit about the OIC. This is our disclaimer: options involve risk, et cetera, et cetera. Any strategies I disclose, including examples, or I discuss, including examples, right? Past performance, not guarantee of future results, et cetera, et cetera. These are trademarks that you'll see used throughout the process. They are wholly owned by the Options Clearing Corporation. Now, a little bit about OIC, just to give you some background. Options Industry Council is the educational arm of our parent company, the Options Clearing Corporation. Options Clearing Corporation is the largest clearing corporation of equity and index exchange traded options in the world. So if you're trading an option that is centrally cleared in the United States, OCC somewhere touches it along the way, whether it's in clearing and settlement, whether it is in the actual process of exercise and assignment, it gets touched by OCC somewhere along the way. OIC, the Options Industry Council, got started in 1992 to better educate the public as to the risks and the benefits of exchange-traded options. We continue to pursue that goal through optionseducation.org. Please check out this website. There is an entire suite of educational resources that we are tirelessly updating and putting new stuff up there all the time. You'll find online courses, podcasts, videos, webinars, all kinds of stuff that's up there, and we're working really hard on modernizing it. There's also going to be in 2024 an entire new set of options tools that are going to be rolled out slowly through Q1, Q2, and Q3. So make sure that you take a look at that. The other thing that is really important is options@theocc.com. This email address is staffed by myself and 3 other investor education team members, all of which have between 20 and 25 years of experience each. I can't talk today. So amongst the 4 of us, we have 100 years of options experience. We answer a ton of questions on a daily basis via email. If you want an answer to your options question, make sure that you reach out to us at options@theocc.com. You will get an actual answer from an actual person who has actual options trading experience, and a lot of it, that day. And it's a great resource that, again, we provide free of charge to the public because we are fully funded by our parent corporation, OCC, the Options Clearing Corporation. So with all of that said, let's dive right in to options volume. One of the things that's really important about this marketplace in particular is that the volume is continuing to increase. On a yearly basis, we are seeing it continue to increase again last year. This is the most recent metric that was released at the very beginning of this year for last year's 2023 year. OCC cleared a record 11.3 billion contracts last year. It is an astounding amount of volume. And if you put it into perspective, back 5 years ago, that number was somewhere around 5 billion contracts. So from my seat as an educator, I look at it and see what we're doing is a vital part of how this options ecosystem continues to expand, because the last thing that any of us want is for people to be in there trading and making leveraged trades, which is what options are, on a daily basis without understanding how they actually work. It's really important that you understand how these options work before you're in there pressing the buttons and making trades in your own account. So that's why we do what we do. That's why we show up to work every day. And that's why I personally leverage all of my experience in trading to make sure that I can transmit as many of those experiences to the people who are out there trading right now. I've made all of the mistakes out there over the last 25 years in many different ways. And my goal is to make sure that I can take all of that experience and help you to make sure that you understand how those mistakes work. And maybe that'll stop you from making them yourself. So on to the actual presentation today. Like I said, we are going to talk about long straddles and long strangles. Those are the real basics, the building blocks of volatility strategies, how these options work, and how their prices are influenced by implied vol. Short straddles, and then we're going to throw iron butterflies in there to make sure that we get a little bit more complex and can understand how these strategies work when you start to put 2 of them together, because that's really what an iron butterfly is. I'll talk a little bit about that as we get into it. We'll discuss strikes and expirations, how you can think about what strikes you might want to choose, or how you could even build a framework around how to think about that. And then we'll talk about P&L throughout as we touch on each one of these. And we'll talk about managing expiration positions and just managing positions in general, how things work when inevitably the underlying moves from where you possibly put this trade on, because the underlying stock is not likely, it's not likely going to stay in the exact same place that it was, at least for the lifetime of the trade. And then we'll have some time for Q&A, hopefully. So let's dive in to the long straddle and the long straddle. We'll hit the straddle first. Long straddle characteristics. These are really the very basics of volatility strategies that are designed to take advantage of large market moves or rising implied volatility levels. Why do they take advantage of these? Because they have defined risk and unlimited profit potential on both sides. That's why the flying V guitar is here, because this is really what the P&L graph looks like. You'll see that in a moment for all of these strategies. They have unlimited profit potential in both directions. Now, as a function of that, because implied volatility is one of the things that you put into the actual pricing for an option, it's one of the biggest inputs into the pricing of options. Rising implied volatility is going to generally, if you keep everything else constant, going to make the prices for these strategies go up. And so if you're long them, long straddles, long strangles, and the implied volatility is going up, generally speaking, these pricings for these options strategies are going to go up as well. That's why they're designed for large market moves and rising implied volatility situations. So what a straddle really is, the basic building blocks of what a straddle is a long call and a long put on the same strike in the same month. That's basically all it is. So if your stock's trading 50 and you want to buy the at the money straddle, you're going to buy the 50 call and the 50 put. Now keep in mind, if you're looking at your pricing and execution software and you buy one straddle, generally speaking, you're going to buy one call and one put. So if you look at your position on that line, let's say you're doing it on the 50 line, you're actually going to have two options on that line. That is the equivalent of one straddle because it is a call and a put. Limited risk as far as these strategies are concerned. That's a big part of what buying options, buying straddles is going to get you. It's going to give you a limited amount of risk. That's part of the reason why people love these strategies, is that you can look at it, see how much you paid for it, and know that that's the most that you can possibly lose. That's what the limited risk aspect of these strategies is. Unlimited upside reward in both directions. I just mentioned that a couple of times. You'll see that in the price graphs that we show in the next couple of slides. Now, this is a point that really needs to be driven home as far as long options are concerned. Theta, which is one of the Greeks that measures time decay of an option. Just a little aside here. Theta is basically a model's measure of how much this option should decay over a 24-hour time period. So if you think about a straddle as two options together, a long call and a long put, the theta of a straddle, because of the fact that the price of the straddle is going to be theoretically twice as much as just buying the call or buying the put, because you're buying both of them, the theta of that straddle is usually going to be twice as much, because each one of those options is decaying at the same rate if they're on the same strike. Now, as I said, rising implied volatility levels affects pricing of these strategies by the prices generally going up. But the converse of that is also true. Decreasing implied volatility levels generally pushes prices of options down, all things being equal. And so theta is one of the forces that's going to be acting against the actual profitability of this trade. But the other thing is going to be the potential of implied volatility coming down. So you have to keep that in mind. Let's talk about the long straddle a little bit more specifically. You're going to be buying one call, like I said, and buying one put, both on the same underlying, on the same expiration date, the same strike price. Typically, the most common straddle that's traded is the at the money straddle, because Those are the actual options that generally people utilize when they're thinking about hedging risk in one direction or another. Let's take a look at what it might look like. So if you are trading, the stock is trading 87.5. What you're actually going to be doing is buying, like I said, one of the 87.5 calls, one of the 87.5 puts. Together, this trade is going to be the long straddle if you're buying it. Obviously, you can make this trade in the opposite direction and be selling it. We'll talk about that in a moment. But to give you an idea of the risk characteristics of what the long straddle does and how it actually either hedges you or gives you the opportunity to make money, we need to talk about the individual options, right? The call itself functions just like a normal call would, and the put itself functions exactly as a put would. However, what you're doing when you buy them as a straddle is you're putting them together. So the call gives you unlimited opportunity to the upside. The put gives you unlimited opportunity to the downside. And when you put them together, you get unlimited opportunity in both directions, upside and downside. Now, what does that look like from a P&L perspective? If you were to, let's say, the 87.5 straddle with 45 days left to expiration, like I said, you're going to be buying the 45, you're going to be buying the 87.5 call and the 87.5 put. That's what's going to comprise the 87.5 straddle. So your maximum gain here, the upside is unlimited. Your downside is what you paid for it. That's your maximum loss here. In this case, if you paid $4 for this straddle, many times if the actual stock is at the money, if it's trading 87.5 and you're buying the 87.5 call and the put, those two options are theoretically, unless there's something very strange going on with the vol path and all kinds of other weird things, the call and the put are basically going to be very close in price, as long as the stock is trading very close to the at the money strike. So let's say you're going to be paying $2 for the call and $2 for the put in this case. Maybe a little bit more for the put. It depends. However, let's assume you're paying $4 for the straddle. If you do that notional math that I always talk about, right? Options are priced in per share dollar terms. So if you're paying $4 for something, you're paying $400 for every one lot of straddles that you buy. When you buy one lot of straddles, you're getting the call and the put. So your maximum risk is what you paid for the strategy because it has defined risk. Long options have defined risk and unlimited potential in both. In either direction, generally speaking. So that's your maximum loss. Your break even here is the strike plus the amount that you paid for the strategy to the upside. So in this case, 87.5 plus the $4 that you paid for the strategy gets you to 91.5. That's your break even on the upside. And on the downside, it's 83.5. It's your strike minus what you paid for the strategy. Essentially, I want you to think about it in this way. Because you paid $4 for this strategy, the stock needs to move enough for either the call to be worth $4 or for the put to be worth $4 for this strategy to be profitable at expiration. Now, between the time that you put the trade on and expiration, it doesn't necessarily have to move past the break even for this to actually be profitable because there's still time value or extrinsic value still left in those options. But when we're talking about break evens, we always express break evens at the point of expiration. Because at the point of expiration, these options go to their intrinsic value. And so in order for this strategy to be profitable at expiration, the actual stock needs to move more than what you paid for it, more than $4, away from the strike in one direction or another. If you move $4 or more to the upside, the call is going to be worth $4 or more. And if you move $4 to the downside, the put's going to be worth $4 or more. And that's where the break evens kick in as far as this strategy is concerned. Now, let's look at a real world example here. Like I said, when you're trading 87.5, the 87 call and the put come in pretty close to the same price. In this case, the put's going to be a little bit more expensive, but ultimately you end up paying $190 for the call and $210 for the put with a net debit of $4. So what does that look like from a P&L perspective? Well, it looks like exactly what we just talked about, right? Here's your flying V guitar. Here's your limited max loss. Anywhere underneath this 0 is going to be a losing part of this trade. And that means that the stock has not moved far enough away at expiration, when these options have just intrinsic value in them, to have overcome the actual theta that we talked about that's coming out every single day. If you end up anywhere between these two break evens, 83.5 and 91.5, you are going to lose what you put into the actual trade, minus whatever either one of these options is worth at that point in time. So if you paid $4 for the whole thing and you end up at 85, your put's going to be worth $2.50, but the call is going to be worthless. So the combination of those two, call and put, is going to be worth $2.50. Well, you paid $4 for it, it's worth $2.50. You lose $1.50 on it. Now, if you get down below these break-even prices to the downside, your put is going to be worth $4 or more, right? You have unlimited profit potential to the downside. That's the put kicking in down here. And you have unlimited profit potential to the upside, past 91.5, where the call will kick in and start to be worth more than the $4 break-even. What you have here is obviously the current share price of 87.5. That's where you are struck on this option strategy. And so when you think about long straddles, I want you to think about the fact that essentially any movement away from the strike in either direction is what you're looking for. You don't need upside movement. You don't need downside movement. You just need movement. You need the thing to move away from the current strike that you're at, to allow for that option, either the call or the put, to expand in intrinsic value at expiration, and thus to overcome the amount that you paid for it, $4. In this case, $400 per one lot. Now, let's take a look at how this actually contrasts to a strangle, because that's the other basic kind of volatility strategy that people use a lot. Now, keep in mind, I'll show this to you, but you can also make this trade in the opposite direction. You can sell this and have limited profit potential and unlimited risk. And that's what it looks like when you sell it. But we're going to talk about the strangle now, as opposed to the straddle. Now, long strangles are almost the exact same thing as long straddles, with the exception of the fact that you're dealing with a call and a put that have different strikes. That's really all you're doing. And so this is, you're combining long out of the money calls and long out of the money puts. Remember, the straddle is, generally speaking, the at the money put and the at the money call. This is the out of the money call, so the upside call, and the out of the money put, the downside put. In this case, because you're long it, you're going to be buying both of those. They have different strikes, but the same month. What you have, again, are some of the same characteristics that you have in the straddle, which is limited risk, because you're buying it, right? The limited risk part doesn't come into play because of the actual strategy itself. The limited risk part is what you're doing with the strategy. So because you're buying either the straddle or buying the strangle, that's where you get limited risk. I don't want you to come away from this and think, oh, well, straddles and strangles all have limited risk just because of what they are. That's not the actual case. You can, like I said, sell the straddle and sell the strangle and have unlimited risk if it moves in either direction. The limited risk comes from actually buying the options and paying for the right to exercise either that call or that put. Always remember, when you're buying options, you have rights. You have the right to exercise. When you are selling options, you are incurring the liability to make that contract whole when someone else exercises. Now, sometimes, and many times, people sell options and they never get assigned on them because maybe they don't come into play. Maybe there's no financial incentive for the other side to actually exercise. And in that case, you just keep the premium that you sold it for. However, don't ever forget, when you're selling options, you are incurring the liability that comes with having to fulfill that contract. And thus you have unlimited price liability on either side of the movement. Now, when we're talking about strangles versus straddles, the thing that many people like about strangles is that they cost less than straddles. Now, why do they cost less than straddles? Well, the reason why is because you're dealing with an option that is farther out of the money. When you're buying strangles, you're buying the out of the money call and the out of the money put. Those options intrinsically cost less than the at the money options. Why? Because they have less of a likelihood to come into play when the underlying moves around. It has to move past the strike that is, maybe 1 standard deviation or 2 standard deviations away before that actual option starts to come into play. Thus, the premium that's charged for that option is less. Also, the delta is less. Many of the things are less when those options are out of the money instead of at the money. So they cost less. This is something that people look at and think, well, I could pay $4 for the straddle, or I could pay $2.50 for the straddle, or the strangle. Which one would I rather buy? Well, if you're thinking just in terms of price, maybe you want to buy the strangle, but you need to understand the differences as far as payout structure and the Greeks that go along with it. Implied volatility here, again, is a big player. It's a big part of how much this option strategy is worth. Why is that? Well, when you're dealing with these options, they are completely comprised of extrinsic value at this point in time when you buy them or when you sell them. If it's an out of the money option, particularly, it has no intrinsic value. It is purely extrinsic value. And what is the biggest part of extrinsic value? Well, there's 2 main big parts: time and implied volatility. The more time that you have in that out of the money option, the more expensive it's going to be. The more implied volatility that you have in that out of the money option, the more expensive it's going to be. Contrast that to the less time and the less implied volatility, and the actual price of the option is going to be less. But what that means is if you're long that option and those 2 things are coming out, time and volatility, those option prices are going to be coming down. So you need to be thinking about that. And that's what this is about. Time isn't on your side. It's not on your side when you're long the options, because you own something that is theoretically depreciating over a daily basis. There's 2 ways that it can really depreciate. The first one is just time. As time comes out, these options come down in value most of the time. The other way that it can depreciate is implied volatility levels can come down. If you paid $4 for it and you bought it on a 20 vol and a 20 implied vol, and now the implied vol is 15, chances are that strangle is not going to be worth $4 anymore. It's going to be worth less than that. So that's what I mean when I say time isn't on your side. It can decay for a couple of different in a couple of different ways. Let's look at a real world example here for the strangle. So we're going to use the same stock, same strike, 87.5, or the same area of where it's trading, 45 days to X again. Instead of the 87.5, remember the straddle is the 2 at the money options. We're going to be buying again the out of the money call, the 90 call, slightly upside. Notice that it is worth less than that $1.90 that we paid for the 87.5 call, and the out of the money put, the 85 put. Instead of the straddle, which costs $4, the strangle costs $2.50. A lot of you are going to say, well, why wouldn't I just buy strangles all the time instead of straddles? Well, here's why. Your maximum gain, again, is unlimited. Your maximum risk, again, is what you paid for it. These are defined risk strategies. Your break even is 82.5 and 92.5. For those of you with photographic memories, you're going to remember that the other break-evens were far inside that. The break-evens here are farther out. Why is that? Because there is a distance that exists between these 2 strikes. Whereas previously on the straddle, the 87.5 strike was right in the middle. So any movement away from 87.5 starts to actually increase the intrinsic value of those options. When you're dealing with a strangle, there's a flat point here between 85 and 90, which you'll see in the graph in just a moment, that actually makes it harder for this thing to make money because it has to move past the 85 strike to the downside and past the 90 strike to the upside for there to be any intrinsic value in these options whatsoever. And so your break evens start to look a little bit farther apart. Now you're paying less for it. And if that, like I said, is your main motivation, then strangles might be the way to go. But it's important that you understand there's no, particularly, I mean, in general, there's no free lunch. In the options world, there's really no free lunch, right? It's all math and it's all perfectly priced most of the time. And so anytime that you're paying less for something, you need to think about the fact that the market, because of the fact that you're paying less for it, is assigning it a lower probability of a payout. And that's part of what the strangle is relative to the straddle. But in this case, you'd be buying the 90 call, remember the upside call, the 85 put, the downside put. And let's look at what this actually looks like. Right? You're buying the 90 call for $1.20, you're buying the 85 put for $1.30. Your total net debit is $2.50. Remember, options are priced on a per share dollar increment. And so $2.50 is actually $250 per one lot. And again, when you're buying one strangle, always remember, you're going to be buying the 85 put and the 90 call in this situation. So don't be surprised if you go buy one strangle and on your sheets the next day, it shows up as two options. That's what it is. That's what this strategy is. So when you think about this, remember what that flying V looked like. It looked like this, right? It was up and down, very steep from the 87.5 in either direction. What you have here is, again, that steepness is here to the downside and to the upside, but there's a $5 difference between these two strikes. That $5 difference is going to show up as a very flat line as far as your P&L graph is concerned. What that means is that between 85 and 90, generally speaking, there's no way this strategy makes money if you're long it. Now, if you're short it, you can go ahead and flip this P&L graph upside down, and it's going to look more like a plateau. And that's a completely different scenario because you're short it, but you're also incurring unlimited risk to both sides. Here you have defined risk and unlimited payout structure to both sides. But your break evens are outside of the other break evens, 82.5 and 92.5. How do you get that? Same way you did with the straddle. Take your entire debit for the strategy, $2.50, and think about that as the amount of premium that has to be overcome in order for this strategy to be profitable. And so you need either the 90 call to be worth more than $2.50 or more, or you need the 85 put to be worth $2.50 or more. When do those two things happen? Well, the 90 call is worth $2.50 above 92.5, and the 85 put is worth $2.50 below 82.5. Short way to do it: take the $2.50 that you paid for it, add it to the top strike, subtract it from the bottom strike. I want you to kind of conceptually understand why that is the case instead of just rote saying, I have to add it to the top strike and subtract it from the bottom strike. That doesn't necessarily get to the idea of learning the mechanics of why these strategies work the way that they do. And that's really what I'm trying to drive home. Many times when I'm teaching these things, I have to kind of keep one leg in the theoretical side of things, which is where I teach how they work, and then give you the other leg on the real world side of things, which is a little bit more of this, which is like, if you pay $2.50 for this thing, this is what it looks like. And I want you to really understand that. But more importantly, I want you to understand why that is the case. Because when you understand why that's the case, you can actually utilize that knowledge and apply it to many, 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 many different option strategies in far more complex ways than just the long straddle or the long strangle. That's when you start to understand, oh, I get it now. I understand why these things work the way that they do. That's what I'm looking for. I'm looking for the aha moments where people are like, oh, it's because the call has to be worth more than $2.50. Yes, that is why this thing works the way that it does. So we've covered long straddles, we've covered long strangles. Now let's move into short straddles and the short iron butterfly. Short straddles are exactly the same thing as long straddles in the opposite direction. So whereas long straddles are looking for big moves in either direction or rising implied volatility levels, short straddles are looking for the exact opposite. You want the stock to go nowhere, and you want implied vol to go down in order for that strategy to make money. As implied vol goes down, straddle prices generally come down, and if you're short it, you're going to make money. If the stock doesn't move, the decay that you're theoretically collecting on a daily basis from being short option premium is going to pay you on a daily basis. Same thing in the opposite way, right? Short straddles combine short at the money calls and short at the money puts. Same strike, same month. May be profitable if the stock stays range bound or around the short strike. There's something I want to talk about here that is important. Your Greeks, as far as your option position are concerned, are going to look differently if the stock moves away from your strike. Why is that? When options are at the money, that is when they have the most gamma and the most theta of anything on the board. Why is that? Because those are the options that are most comprised of extrinsic premium, that are the biggest options that are extrinsic, essentially. You can find bigger options, but those options are going to have a portion of their value that's going to be intrinsic premium, meaning they're going to be in the money options. The at the money option is going to be the largest option on the board in that month that is comprised completely of extrinsic value. And so when you're at the money, they have high levels of gamma and high levels of theta. If you were to say sell a short straddle and then the stock moved away, what you're going to end up with is a position that is probably not profitable because the large move happened and you're short the optionality. But what you're also going to end up with is something that looks completely different from a Greek perspective. Your delta is going to be completely different, your gamma is going to be completely different, and your theta is going to be completely different. Why is that? Because those options have changed their Greek characteristics as the underlying has moved away and changed the way that that option looks. A much larger percentage of that option may be comprised of its intrinsic value relative to extrinsic value. And if you have an option with high intrinsic value, it's not going to have exceptionally high levels of gamma or theta. And so a lot of people will ask questions like, I sold this straddle and I was collecting, $175 of theta every day, and now the stock moved. What happened to my theta? I'm supposed to get theta every day. Well, you're only supposed to get theta every day if the stock is sitting at the point at which you sold the straddle, because the straddle is starting to decay. Once the stock moves away and that call potentially has a very high delta and thus a very high price, there's not as much extrinsic value left in that option. It's mostly comprised of intrinsic value. Well, guess what? Intrinsic value doesn't decay at the same rate extrinsic value does. That's why in the money options have a different decay feature than out of the money options that have a theoretical kind of exponential decay feature as time comes closer to expiration. Those in the money options don't decay in the same way. They have a very linear decay function. So that's a long way to explain this around the short strike thing. If you're short options around where the stock is, that's generally when decay actually happens. But if you move away from your short strike, don't expect the same amount of decay because the options aren't priced in the same way. Another part that's really important, unlimited risk. When you are short options, whether they be straddles or strangles, if you are short units, indeed, meaning if you're long a straddle and short a strangle outside it, but the strangle is actually 2 units versus the straddle being 1 unit, you are still going to have unlimited risk. It's going to be farther away, but the short unit, the short optionality is what actually creates the unlimited risk. Much like what I said earlier, it's not the strategy itself that creates the defined risk when you're talking about long straddles and long strangles. It's what you do with them. It's buying the options that gives you the limited risk and unlimited profit potential. In this case, it's the opposite. Selling the options is what creates the unlimited risk, not the straddle itself. It's the short part of the straddle or strangle that creates unlimited risk. And we'll talk about that in a minute. Time may be on your side again, as far as decay is concerned. We just discussed that. Remember, decay happens most likely when you're close to your short strike. That's why if you have multiple strikes on that are long, short, long, short, long, short, if you're looking for a profitable position, especially around expiration, you want the stock to be at your short strike, because that's when option prices start to come in as you get closer to expiration. Let's look at a short straddle example. We're going to use the same price, same days to expiration, same prices of options, right? You'll remember this from the previous iteration, but flipped, right? We talked about a straddle as a long straddle. Now we're going to talk about a straddle as a short straddle. It's going to look like a flying V, but flipped upside down. 87.5 call at 190, 87.5 put at 210. You're selling that straddle for $4. So what does it look like? It's the exact same thing, except it's upside down. These blue lines should actually have, arrows on them to actually show you that there's unlimited risk going on here. Theoretically, you have unlimited loss to the downside and to the upside. Why is that? It's the exact same thing as the long straddle, but flipped. Think about this. If you're selling this to someone else. What does their P&L graph look like? Well, their P&L graph looks like this. The first one we looked at, the long straddle. Well, what does that mean? If you're short it and you sold it to them, your P&L graph looks the exact opposite. The most you can make is if the straddle goes out worth 0, which would be at 87.5, where the call and the put both are worth 0. That's called pinning the strike. If you sell the 87.5 straddle for $4 and the stock finishes 87.5, neither the person who owns the call nor the person who owns the put is financially incentivized to exercise either one of those options, because the stock is trading 87.5. And so generally speaking, many times those options will not get exercised, or a certain percentage of them will get exercised based on whether people think the stock's going to go up or down. And then the straddle actually goes out worthless. Then you get to keep all of the money that you took in when you sold the straddle for $4, which is $400. Outside of that, your break evens are the exact same, but in the opposite direction, right? 87.5 minus $4 to the downside, 83.5, and 87.5 plus $4 to the upside. Inside that range, you're going to be making money, because either the call or the put is going to be worth something, maybe, but less than $4 at expiration, when only its value is comprised of intrinsic value. All right, let's talk about spreads a little bit as a segue to the actual next strategy we're going to talk about. Spreads have lower risk than naked option positions. They have, generally speaking, limited profit and loss potential because they are a combination of a buy and a sell. Now, generally speaking, they also have more commissions associated with them. Why? Because it's two options. And if you're trading one spread, or you're trading a 1x2, or you're trading a 1x3, you might be trading 4 options, right? So you have to keep in mind that the amount of fees and commissions that you're paying when you're trading spreads is going to be more than actual naked options, one lots. It's important that you have a specific time and price forecast when you're talking about spreads. Why? Because they have this limited profit and loss potential. And it's important that you kind of bring that into the framework within which you think about spreads. Now, the long butterfly is a combination of either a bull call spread and a bear call spread put kind of stacked on top of each other, or a bear put spread and a bull put spread, again, stacked on top of each other. So they're going to consist of 3 option series, meaning 3 different strikes, usually a butterfly is. And traditional butterflies are almost always all calls or all puts. Now, that isn't necessarily the case when you're talking about iron butterflies or iron condors. They are generally calls and puts combined. But when you're talking about a butterfly on its own, the traditional way to trade it is, you would quote the 87.5, 90, 92.5 call fly. And that would be how you would quote it, execute it, and how you would kind of manage it from a risk management perspective. Generally speaking, when you're talking about butterflies, the strikes are also equal distance apart. Now, why do people trade butterflies? They have defined risk, much like spreads on their own. Because they are two spreads kind of stuck together, they are going to have defined risk as well. You'll see that. However, the defined risk starts to get a little bit more complicated when you add more strikes and more options to the strategy. That's not uncommon. Now, the cost of butterflies are generally less, much in the same way that strangles are less than straddles. The cost of these butterflies can be less because you're dealing with buying one option, selling two options, and buying one option. You have a limited amount of premium that's involved in the whole thing because you're not just buying two options on the outside, you're also selling the options in the middle. That's usually how butterflies and their cost perspective works. They can be structured delta neutral, meaning you can create a butterfly where you're trading the at the money straddle versus the out of the money strangle. We'll look at that in a moment. And it can be almost purely delta neutral, meaning you have essentially no exposure to the underlying as long as the underlying stays exactly where it is. Delta neutral butterflies change their delta neutral characteristics when things move. Much like what I said earlier, options changing from a percentage of their value being intrinsic versus extrinsic and moving in that way, the actual butterfly itself can move in that way as well when things move around. All of the options that are involved in that strategy are doing that dance between intrinsic and extrinsic value, how much delta they have, how much gamma they have, and they're moving as the stock is moving. It's like a three-dimensional chess game. Potentially, these can be created where you have positive theta, but most of the time that only happens when the stock is right next to the short strike. That's part of what I was trying to get the point across earlier. Your position changes and your theta amount will change, much like your Greeks will change when the underlying moves. Keep an eye on where the underlying is relative to your short or long strikes, because if you're really far away from your short strike, it's not going to have the same characteristics that it had potentially when you put it on, if you put it on when the stock was trading right at your short strike. Butterflies sometimes give people the opportunity to sell implied vol in a defined way with limited risk. If you're in a situation where implied vol is very high, many times implied vol is very high because things are moving around a lot. Not always, but many times that's the case. A lot of times people will look at that and say, well, I don't want to just sell straddles or sell strangles and have unlimited risk to the upside and the downside. What happens if I buy this butterfly instead? What that will do theoretically is it keeps you flat units, right? Long one, short two, long one. So your flat units, 1 minus 2 plus 1, right? You end up with 0. And it matters where the stock is relative to your strikes as to whether or not you are short or long premium, option premium. The closer you are to your long strikes, the longer option premium you're going to be. The closer you are to your short strikes, the shorter option premium you're going to be. That's going to be reflected in your decay, either coming in a big way or potentially not coming in at all, and even potentially paying money if you're actually close to a long strike that has a lot of option premium built into it. You can also structure these in a bullish, bearish, or a relatively neutral way, butterflies in general. Now, that's butterflies in general. Let's talk about the iron butterfly, which is, generally speaking, we take iron butterflies as a neutral to range bound or falling implied volatility levels. Again, this is a lot like being just short straddles, but in a slightly more defined risk way. What you're really doing here, and this is the reason why I try to explain those other strategies in a way that gives you a real good theoretical idea of how they work, because now what we're going to do is we're going to take both of those strategies and we're going to lay them on top of each other. Out of the money strangle and a short at the money straddle. So think about this. We talked about the 87.5 straddle being short or long, the 87.5 call and the 87.5 put. In this case, we're going to be short that straddle, and against that, you're going to actually buy the outside strangle. What that does is it functions as if you have both a call spread and a put spread on. You're short a call spread, the at the money to the upside call spread, and you're short the at the money to the downside put spread. That's what this means. Selling a bull put credit spread and selling a bear call credit spread. You're selling the call spread, you're selling the put spread. Your max profit's going to be when you're at your short strikes at expiration, and you have, by function of having two spreads on instead of naked options on either direction, you have limited risk in both directions. Now, time can be on your side. Decay, as I've talked about relentlessly through this, if the stock is in the right spot. The moment the stock starts to move away from your short strikes, you have to consider how those spreads are either expanding or contracting. Usually one of them is going to be expanding and one of them is going to be contracting in price. And in the opposite direction, you know, the call spread may expand and the put spread may contract in price. But the theta that you're going to get from these strategies is generally going to be the most when you're at or around those short strikes that you have on. So let's look at an example of this. Again, we're 87.5, 45 days to expiration. Sell that 87.5 straddle at $4. If you remember, we all remember what that looked like, right? It's the opposite of the flying V. And against that, this is where the defined risk part comes in. You're going to buy that outside strangle, the 85 put and the 90 call, the downside put and the 90 call. We all remember what that looked like, right? It looked like this. Flat area between the 85s and the 90s with unlimited profit potential going out on either side. Well, what happens when you put those two things together? In price terms, you end up with the straddle you sold is more than the strangle you're buying. So you're going to have a net credit for the entire thing, but what you're really taking in is $1.50 instead of $4 if you just sold the straddle. And what does that look like from a P&L graph perspective? Well, let's wait for a moment, talk about an interesting part of this. Your max gain here is your net credit. It's only $1.50. So the most you can make on this is $1.50. What are you giving up? You're giving up the actual unlimited part of the risk, but you're also giving up the amount that you would sell it for. You're selling it for a lot less than you normally would if you were selling just the straddle. And so your maximum risk here becomes $1. Why $1? Because you have two spreads on. You have a call spread that is a $2.50 call spread, the 87.5 to 90 call. And you have a $2.50 put spread on, the 85 to 87.5 put spread. What's the most that either one of those spreads can be worth? The distance between the strikes, or $2.50. However, if one of those spreads ends up worth $2.50, you've already sold the whole thing for $1.50, which, if anyone remembers, when you sell or buy options, the actual premium that you take in when you're selling or that you pay out when you're buying them immediately comes into your account if you're selling it, or comes out of your account when you're buying it. And that never changes. That amount of premium comes out or into your account the moment you trade, and that never goes anywhere. If it comes out of your account, it stays out of your account. If it comes into your account, it stays in your account. But what ends up happening is the strategy that you have on has a different price each day that gets marked to market, and thus you have to be margined as to how much it's worth relative to how much money you have in your account, et cetera, et cetera. But as far as maximum risk is concerned, it's $1 because you've already sold it for $1.50, and the call spread can only be worth $2.50, or the put spread can only be worth $2.50, but both of them can't be worth $2.50 at the same time at expiration. So your break even is calculated by taking your short strike and adding the credit that you received, which gets you to 89, and your lower break even is the short strike minus the credit you received, which gets you to 86. Assignment at expiration can change this significantly. The reason why I say this is because many times people look at strategies like this and think, well, I'm just flat options, so it doesn't really matter. The fact of the matter is, if you are in between your short and your long strike, meaning if you're in between 87.5 and 85 to the downside, in between those two put strikes, you have an interesting assignment expiration situation where you're probably going to be assigned on your 87.5 put, but it might not be financially advantageous enough for you to actually exercise your 85 put. And so you need to pay attention to that, because what that's going to create theoretically is potentially a long stock position if you're in a situation where you get assigned on a short put. Now, let's look at the short iron butterfly really quickly. We're running out of time here, I know. Our net credit's $1.50 on this. What does this look like? It looks like the straddle, the short straddle, combined with the long strangle. Now, a lot of people are going to look at this and say, why are these lines flat instead of going up? When you combine these two lines, the strangle, if it were by itself, would be up as far as profit to the downside and to the upside. But you have to keep in mind, you are still short a straddle, which is going straight down as far as P&L is concerned here. So the combination of the straddle losing money and the strangle making money actually gets you that defined max loss of $1 to the downside and the same to the upside. That's why the P&L graph looks this way. Now, the max you can make on this is $1.50, which is what you took in when you sold the strategy. So a lot of people are going to look at this and say, well, these numbers are pretty small relative to selling a straddle for $4. That is the case. Yes, they are much smaller, but you are incurring a significantly less amount of unlimited risk as far as profit and risk is concerned, right? When I say there's no such thing as a free lunch, generally speaking, if you're selling things naked for a significant amount of premium, you're also incurring a significant amount of liability as far as P&L is concerned. When you have defined risk like this, these numbers can be much smaller, but they are also defined. You know exactly what your payout structure looks like if the stock moves. So let's look at the Greeks really fast here. Short straddles and short iron butterflies. The delta varies on these. If you're using at the money options, it's going to be relatively neutral, but it can also be structured directionally, bullish or bearish. Now, gamma on short straddles and short iron butterflies is most of the time going to be negative as long as the stock is around the short strike. That means when the underlying price goes up, your gamma, your negative gamma, is getting you shorter delta on the way up. And when the stock goes down, your gamma, your negative gamma, is getting you longer delta on the way down. It's not the best as far as delta is concerned, as far as movement. You would ideally like for other things to be happening, where you're getting long on the way up and short on the way down, but this is a function of short optionality. Short options come with short gamma. They also come, theoretically, with positive theta. For taking this risk, this gamma risk, you are theoretically being compensated by getting the positive theta. The extrinsic value of these options is theoretically decreasing as time goes on, and that is coming into you if you are short those options. Now, the vega of these positions is generally negative as long as you're around those at the money options, and the decrease in implied volatility is going to be beneficial for this. It's going to make the price of that straddle come down faster than the price of the strangle on the outside. Let's look at risk versus reward real fast. Again, short straddles have higher profit potential than the short iron butterfly. They also have higher risk and higher max loss potential than those short iron butterflies. The trading range for the profit on the short straddle is going to be wider because you're selling more premium and thus your break evens are farther apart. And the iron butterfly is going to have a narrower price distribution there. The implied volatility exposure for both of these is going to be the same. You're going to be, generally speaking, short optionality. And thus, as implied vol levels come down, the price of these options generally comes down. Now, here's some takeaways I want you to take away. Long straddles and strangles are defined risk. Why are they defined? Because you're long optionality. They're defined because you have the right to actually exercise either that call or that put. That's where the defined strategy comes from, the defined risk within the strategy. And also keep in mind, long straddles and strangles are generally, when things are moving around, they are going to do well when things move far away from the strikes. Because of that flip between intrinsic and extrinsic value. As extrinsic value becomes more intrinsic value, the delta of those options increases, the price of those options generally increases, and thus the price of the strategy generally increases. That's why those things go up in value when things move around a lot. Now, short iron butterflies are defined risk because they're flat options, and some people use them, just like butterflies, to sell option vol or take advantage of something that's not moving around or that they theoretically think is not going to move around very much. Because as the stock stays closer to your short strike, the theta of those options is coming out of them on a daily basis. Implied vol levels are very important as far as the prices of these option strategies are concerned. When you see implied vol go up, the price of the straddle, if everything else is static, is going up. The price of the strangle, probably also going up. The contrast of that is also true. If you see implied vols coming down, if everything else is staying constant, the price of the straddle and the price of the strangle are most likely coming down as well. Theta of options is variable. I touched on this many, many times throughout this. It's dependent on the position of the strikes relative to the underlying price levels. If you're close to your short strike, you're probably going to be collecting more money than you will be if you're close to your long strike. That's the basic takeaway there. And then all of these strategies, you can construct them in different ways, bullish, bearish, or neutral. Generally speaking, if you move the strikes around in different ways, and if you want to talk about that, send me an email and I can talk to your blue in the face about how the strikes work relative to your idea of bullishness or bearishness as far as that's concerned. But you also have to understand how the Greeks work when you start to move strikes around outside of the normal kind of price distribution of out of the money strangles and at the money straddles. So I think that's pretty much it. I know we came in a little bit long. I'm generally long-winded, Andrew. I apologize for that. I hope we touched on what we needed to.
Absolutely. Very nice presentation, Matt. I'm going to wind up with a couple of questions here. One's in and one's out. Henry asks, can you comment on how to identify the ideal market conditions for each of these vol strategies? And Pierre asks, my question is mostly related to exit plan. When will be the best time to exit each strategy?
Okay, I like these questions. If you consider that implied volatility is a huge part of how these prices are structured, and that underlying volatility, which is how much the actual stock is moving, is going to be a huge factor in whether or not the actual strategies themselves are profitable or not. Generally speaking, the best way that these can line up is when you're selling an exceptionally high level of implied volatility and the stock is not delivering that amount of implied volatility, or the opposite of that. If you're buying options, you want to theoretically, and this is just purely a theoretical statement, you want to be buying the lowest level of implied volatility relative to the amount that the stock or the index is delivering or moving around. For this very reason, many times people that trade pure vol arb strategies look at and track very closely what we call historical volatility or delivered volatility and implied volatility. Implied volatility is the volatility that you're trading, that the price that you're trading is linked to. So if you're paying $4 for a straddle, you might be buying a 20 vol. If the stock is moving on a 50 vol, that straddle's probably going to be profitable. But if the converse of that is true and you're buying a 20 vol and the stock's moving on a 5 vol, it's probably not going to be profitable. Now, there are edge cases, tail risk that exists out there where those two constructs you can throw out the window. But when you ask me a general question about like what's the optimal situation, the way that this lines up perfectly, I have to tell you theoretically the best way that these generally line up from a vol arb perspective is if you're selling an exceptionally high vol and it doesn't deliver, or if you're buying an exceptionally low vol and it over delivers. So that's the kind of general answer to that question. And then the answer to the other question is exit strategy for these things. Many times, if you are going to be long optionality, what people generally like to do is once you get, if you're looking at this and thinking like, I'm buying this for a move, I'm buying this because I think there's going to be a move. What you also need to consider is once the move happens, what's my plan? Because oftentimes the move will happen, and then if people are expecting something to happen for this move to happen, generally speaking, the option market will build in a certain amount of implied volatility into the price. Once that move generally happens, those are what I call vol reducing events, earnings, elections, USDA crop reports, things of that nature, unemployment numbers, inflation metrics. If you get the move, all of that implied vol that was pumped into those options, a lot of times will come out of those options after the move happens. And thus what you'll see is what we call a deflation of price coming out of those options. And so a lot of times people will actually harvest, they'll profit harvest these strategies when the move is happening, because what that gives them is the ability to actually harvest the move while the implied volatility level stays where it was before things come in. As people start to, you have to think about when things are happening, before something happens, you have these, you have the known knowns and the unknown unknowns and the known unknowns and all, right? There's a certain amount of things that people don't know. As more certainty gets added to the marketplace, generally speaking, what happens is the fear of the unknown comes out. And thus, when the fear of the unknown comes out, the implied volatility levels generally come in. And so if you can find a sweet spot where maybe the move is still happening and people haven't been able to fully process everything that's going on, and thus take the options vols down to zero, that can be a good mix of those two things where you're still getting movement, but you're also not getting a vol crush event where all the implied vol comes out. I hope that I have to dance around a little bit as far as those answers are concerned, because technically I'm not an RIA and I can't give you, investment advice or trading advice for that matter.
Regardless, Matt, excellent responses to those questions. And I'm going to send you additional questions later this afternoon in spreadsheet format. And as usual, I know you'll get back to people who have asked questions that we don't have time to answer here. But thank you very much for joining me. That's a wonderful presentation, Matt.
Absolutely. Thanks for having me. I look forward to I'll be back next month, I think, late in the month, and we're going to talk about, I think, the mathless Greeks.
Ooh, mathless Greeks. That sounds like a podcast mystery series.
I like it. We might have one of those as well.
All right. Thank you very much to the audience, and thanks again, Matt Cashman.
Indeed. Thanks, Andrew.
All right. Bye for now.